This is Duke University.
I'm Ed Balleisen, Associate Professor of History here at Duke and Senior Fellow at the Cohen Institute for Ethics. And I'm also the convener of the Rethinking Regulation project at Cohen that involves events like this and a working group, interdisciplinary working group of faculty to think through the challenges of regulatory governance in the wake of the series of crises, including the financial crisis that have beset the global community over the last couple of years. This summer, the United States Congress enacted, depending on one's point of view, the most far-reaching overhaul of national regulatory policy for the financial system since the New Deal, or a patchwork of technical fixes that do little to tame the ever more powerful beasts of finance. We have a fantastic panel to discuss this reform effort and its implications for the nation's financial system. The three people on the panel, scattered around the table, are first Dan Ariely, the James B. Duke Professor of Behavioral Economics at Duke's Fuqua School of Business, a regular commentator on NPR's Marketplace, and the author most recently of two widely read and influential books, The Upside of Irrationality and Predictably Irrational. Second, we have Lawrence Baxter. Over the last 30 years, Professor Baxter has variously been a legal scholar at Duke and before that the University of Natal in South Africa, where he has taught and written about financial regulation. He's also been special counsel to the United States Senate Committee on Banking, Housing, and Urban Affairs, where he helped to draft legislative responses to the savings and loan crisis in the early 1990s. And he has spent several years as a high-level executive at the Wachovia Corporation. And finally, we have Bill Cohen. Am I right? A graduate of Duke University and a Wall Street banker for 17 years at a few firms. He is a financial journalist and a columnist at the New York Times, as well as the author of two acclaimed books on Wall Street. The Last Tycoons, The Secret History of Lazard Bear & Company, and House of Cards, A Tale of Hubris and Wretched Excess on Wall Street, which details the failure of Bear Stearns. Cohen is also a member of the advisory board of the Cohen Institute for Ethics. So eventually, we're gonna open this up to a more general conversation, but what I want to do first is just very briefly sketch the key pieces of the Dodd-Frank legislation. An extraordinary complex piece of legislation that reconfigures the goals, structures, and authority of numerous federal agencies and that creates new rights and obligations for a wide array of financial corporations and firms. So I'm going to sketch out those key goals and then begin the conversation with some questions that are targeted particularly at the panelists, and then eventually we'll offer other people a chance to pose questions as well or make observations. Obviously, any summary of this kind of legislation is inevitably going to oversimplify. But I will take a crack at giving us a point of departure, linking some key provisions of the statute to the broad regulatory purposes underlying those provisions. So, Dodd-Frank seeks to do the following 5 things. It seeks to do other things too, but I'm just going to focus on these 5. First, make the financial system more stable. The key means here involve the creation of a new stability council, interagency stability council, to identify emerging threats to financial stability, and to identify firms whose activities pose a threat to systemic stability, which could trigger the imposition of a tougher regulatory regime over those firms through limits on leverage or higher capital requirements, even holding out the possibility of requiring excessively complex large firms to break themselves up. So that's the first key goal. Second, to improve investor protection in complex derivatives trading, so as to sustain confidence in the market for securitized debt. Leading provisions in this regard include heightened transparency through the requirement of trading many derivatives in standardized forms on public exchanges, a requirement that packagers of securitized debt instruments have skin in the game, that they have an ownership stake in the products that they market and sell, and tougher regulations on ratings agencies involving review of their performance, prohibitions on conflicts of interest, and introductions of both new sanctions and potential liability for negligent rating processes. A third key goal, to encourage institutional investors to discriminate more carefully in investment decisions and rely less on credit ratings agencies. The key mechanism here is the removal of the requirement that funds with fiduciary responsibilities invest in debt instruments that have AAA ratings. A fourth key purpose or goal, to insulate taxpayers from the direct fallout of financial crises. The central policies to achieve this goal include new constraints on public bailouts of financial firms, a requirement of advanced corporate funeral arrangements for large-scale financial institutions, ensuring the possibility of dealing with insolvency in an orderly fashion, and finally, a new resolution authority to handle failures by complex, large-scale financial firms. The final goal that I'm going to stress here briefly is to improve consumer protection in financial transactions, especially involving credit. The legislation mandates both increased investment in financial education and a new Consumer Financial Protection Bureau housed in the Federal Reserve with rulemaking and enforcement power over the consumer credit practices of large-scale financial actors. What all of this means in practice remains very much a contingent question, dependent on decision-making within several new bureaucratic entities, additional processes of administrative rulemaking, and the development and implementation of various enforcement strategies. So I'd like to start the discussion by asking the panelists just this first question. Has this legislation tackled the right challenges created by the global financial crisis? Is it in fact actually targeting the key problems? Lawrence, would you like to start?
Yes, thank you. I think it has purported to do so. So in other words, all the sort of points of controversy have been addressed, but I think they've been very inadequately addressed because the real hard choices have either been delegated to the regulators in situations where it seems to me implausible that they'll be able to take the kind of action they need to take to moderate another crisis. I don't think they will absolutely prevent one. All that's the issue. The main issue is restructuring the industry, in my view. Not necessarily bringing back a Glass-Steagall division between commercial and investment banking, but I would say more focused on the impact of the extremely large institutions. Now, I hand out that slide. In fairness, for the sake of accuracy, the slide's a year old, and these institutions have reduced a little in size, but you'll see that the capital supporting them is modest. The scale of the large universal banks around the world, and they're already global now, is, I believe, beyond the capacity for managing them properly and beyond our ability to do much about it when one of them crashes without them managing the crisis. So I sort of see the analogy as we have an ecology in which some of the denizens in that ecology have gotten too big, are very vulnerable to infections among each other, and are stifling the healthy evolution of the financial ecology for everybody else. And that, I think, is the heart of the problem. And it was dubbed by the Congress. They basically delegated to the regulators the ability to restrict growth and perhaps even break up institutions. My feeling is that Congress couldn't do it itself. I don't see regulators being able to do it except in moments of crisis when it's too late.
Cohen.
I would agree with a lot of what was just said. I mean, I think that this decision to turn over to regulators the writing of the provisions of how this bill is actually going to work is extraordinary, and it's incredible to have a 2,300-page law that nobody knows how it works. I mean, I don't know exactly how many pages Glass-Steagall was, but you know, probably fewer than 50. And it was very clear what was supposed to happen. You had to choose in a couple of years whether you were going to be in the commercial banking business or the investment banking business, among other things. And it was very clear there was no one there to write regulations. And now you've got this 2,300-page behemoth. Nobody knows how it's going to work. Turned over to the regulators to write how it's going to work. And now we've had a midterm election where we've got a wholesale shift now to the right, which only is going to mean that Wall Street is going to get its hooks once again into the people, into Congress, and then into who will then use their influence on the regulators, and so we'll have a utter watering down, I think, of the intent of the legislation. Which I also worry, misses the boat pretty much completely, which is a shame. I mean, I think one of the good provisions that was included is this requirement that derivatives get put on exchanges, because one of the major problems in this crisis was the lack of transparency with regard to the valuation of certain derivative-type securities, which caused huge collateral disputes among institutions. Everyone, I think, probably by now is familiar with the major collateral disputes that occurred between Goldman Sachs and AIG. AIG had insured a security, at 100 cents on the dollar that Goldman valued for whatever reasons, let's say 60 cents on the dollar, and then demanded collateral from AIG to make them whole between 60 and 100 cents, setting off a huge firestorm of monthly collateral disputes between the two firms, beginning in 2007 and continuing on until 2008 when AIG failed. So one of the things that I think is good is by having these securities traded on an exchange, the bid and ask will narrow. You'll have a clearing agent. The collateral will be put up in much more traditional ways, and I think that's a good thing. Other than that, though, I'm afraid that the legislation pretty much misses the boat completely.
So what is the big issue that was missed?
Well, okay, this is the Bill Cohen hymnal now that I'm singing from. So basically, my feeling goes back to human nature. These crises, which have come about in rapid succession over the last 25 years with increasing severity each time. I mean, this wasn't the first financial crisis we've had in the last 25 years. Unfortunately, I don't think it's going to be the last, and it all derives, from my perspective, from a failure to address what motivates people to do things. And on Wall Street, what motivates people to do things is to get as big a paycheck as they possibly can, as quickly as they possibly can. Now, that's changed. Once upon a time, when these firms were small private partnerships, where their partners' capital was on the line every day, they were much more focused on what each of their partners were doing and the risks they were taking, which doesn't mean to say that Wall Street hasn't historically been a dangerous place, because it has always been a dangerous place. Firms have been going in and out of business for a long time. But basically, after the reforms in the early 1930s, there was a period of stability, more or less. Again, not that firms didn't go out of business, but as we now know, from 1933 or so until the mid-80s, I mean, things were relatively calm on Wall Street. Yes, firms did go out of business, but the losses were contained to the partners who had invested their capital in the firm. Beginning in 1970, that began to change when a firm named Donaldson, Lufkin, Jenrette went public, shocked the New York Stock Exchange governors, and then very quickly all the firms on Wall Street went public and ended up, unfortunately, substituting their partners' capital with outsiders' capital, creditors, shareholders, and basically all the incentives changed. What went from a culture focused on pre-tax profitability and minimizing risks and serving their clients went very much into a bonus culture, which I was a beneficiary of. for 17 years, so I know it well. A bonus culture that unfortunately encouraged people to take what I call asynchronous risks with other people's money. In other words, they get paid a lot of money when they generate revenue, and they don't suffer the consequences when the whole system blows up. And that's why we've had any number, and I can get into in more detail why I think all of these crises that we've had since I went to Wall Street in '87, and there's been about 10 of them. Each of them is frankly driven by compensation system, none of which is addressed in this 2,300-page piece of legislation.
So Lawrence is pointing to structural concerns about size, and you're pointing to structural concerns about governance and ownership.
And human nature.
Dan, would you like to pick up on that?
So I'll add to the human nature part. So I think, I don't know much about banking, but I think every legislation has a theory of mind. In the sense it says what is the driver of human behavior. It's really a psychological antidote. It's saying here's how people behave and here's what we need to regulate. And there's a few things you can think about. Are people evil? And if people are evil, you can just prevent them from being evil. Are people concerned with what other people think about them? Or can the market regulate itself if everything was just sunshine policy and transparency? And I think those are kind of the two views of human nature reflected in this. Right? Evil we're just going to try and eliminate, and we're going to use transparency for self-regulation, so people know what the thing is. But I think that none of those captures correctly the psychology of bankers, who I think are inherently, to a large degree, not evil, but placed in tremendous situation of conflicts of interest. And a lot of us here do research on conflicts of interest, and I think it's one of those things that have tremendous impact on human behavior. We just don't see it, and that's not the dangerous part, because we all understand that other people are susceptible to conflicts of interest. We just don't see it in ourselves. I'll give you a different example. I had a miserable 4 weeks because I went on NPR and I said something not nice about dentists. True, but not nice. And I basically pointed out that when dentists see an X-ray, they find cavities. And then if you show the same X-ray to another dentist, they also find cavities, just not in the same teeth. And papers differ on this, but the reliability looks like about 50%. It also looks like 75% of wisdom teeth extractions are unneeded. And you can ask whether dentists are evil. After I went on NPR, the head of the American Dentists Association emailed 155,000 dentists with my email. So I got lots of emails from angry dentists, and here's how my discussion with them usually goes. They write me an email that has 3 paragraphs. The first paragraph is saying, Dan, you're an idiot, with some, they expand on this. Then they say, I always do what's best for my clients. And then they say, some dentists are bad apples. These things happen to some people, not me, and so on. But what I usually do is I say, let's not think about dentists for a while. I said, let's think about heart surgeons. And I said, do you believe that heart surgeons put too much stents in people's hearts? They said, yes. The evidence is quite clear. I said, do you think they do it because they're evil, or because they get paid to see things being solved by heart stents? And they said, they get paid. Then I said, don't you think dentistry could be the same? He said, not in my clinic. And I think this is kind of the basic problem of bankers as well. That there's few people who plan deception, but I think most of them have a tremendous worldview in which they are the fighters, the freedom fighters of capitalism, that they are the people who are driving the economy, that they are contributing tremendously to the wealth of everybody around them, and it's shocking to them to see these behaviors. And now the question is, how do you fight in the legislation our inherent ability to believe lots of stuff and truly believe that in a way that suits our personal interests? And I think that's that for me is probably the biggest part of the pie, if you think about the type of what regulation you need to do that hasn't been touched. And I think this is why bonuses are so important, because the bonus is the driver for the incentive that then changes people's worldview about what's right and what's wrong. And if we don't fix that, if we don't fix the motivation, we're not going to get people to have an objective worldview. And that's not the real challenge.
So there's an implementation process still to come, right? There are literally hundreds of rules that have to be written.
Actually, can I say something?
Yes.
So I testified to the FCC and I get some reports from time to time. So apparently there was some report last week that tried to convince that the SEC that if you create transparency in the financial system, that would actually work against consumers. Because now the cost would increase. I mean, basically kind of a very long, convoluted argument which I couldn't follow. But basically, and I was just thinking, imagine somebody who's a banker who really doesn't want transparency. Because, if we all saw how much fees we're paying on our 401k plans, we would be shocked when it comes to it. And we saw the hidden fees and all the back transactions and so on. It's really quite amazing. And there are people, I think, who truly believe, and this report felt like somebody was truly believing that exposing these fees to investors would actually hurt them in the long term. And they were able to come up with fantastic solutions. Last thing, we asked the question of which kind of people are better able to kind of tell themselves stories about why they're doing is okay. And we find out that it's creative people. So it turns out creative people can cheat more and at the same time feel good about themselves. Why? Because creativity is all about telling ourselves stories. Right? And if you're better at this, you can justify more stuff. We have very smart, very creative people in banking. Right? They can tell fantastic stories.
So the process as it's going to move from here involves tremendous requirements of implementation. So the 2,300 pages include many instructions to the Federal Reserve, to this new Stability Council, to many other players to fill out the detailed implications of the new frameworks that have been set by this legislation. Could the three of you perhaps reflect on maybe just one or two examples of where that process of implementation is really worth watching and where it's at least possible that some of these issues that you've addressed might be dealt with in the administrative regulatory process as opposed to the legislative one?
I'll go first because that way, when the other two say things about implementation, then I'm stuck and I don't know what to say anymore because I don't know the bill all that well. But I mean, I think that one of the things that has been fascinating for me to watch is the implementation or the effects, the ripple effects of the so-called Volcker Rule, which is buried in this legislation somewhere. Everybody talks about it, which, and I'm sure you're familiar basically with the gist of it, but here is this guy, Paul Volcker, who was chairman of the Fed for a long time, before Alan Greenspan, and is now in his low 80s, just got remarried to his longtime secretary, which is sort of interesting. Then was making a lot of sense from the sidelines for a long time. Was theoretically close to Obama, but not really included in the administration in any substantive way, and was making a lot of sense about how financial reform should work from the sidelines as the bill was being put together. And then after Scott Brown won in Massachusetts, next thing you know, Volcker is standing next to Obama, and we hear about the Volcker Rule, which was his proposal that Wall Street firms no longer be in proprietary trading, hedge funds, or private equity. And that's the exact moment I think he stopped making any sense. So he was doing great when he was from the outside looking in, and then they co-opted him, brought him in, and he comes up with this idea, it's now the Volcker rule, that for a long time didn't look like it was going to survive, but then did survive, and frankly makes no sense to me whatsoever, which is, believe it or not, proprietary trading, hedge funds, and private equity had nothing to do with this crisis, and had very little to do with any of the crises that we've experienced in the last 25 years. So why it's actually in there, I don't know, but you can, because the thing is, Congress seems to think, they hear the word hedge fund or proprietary trading, and then all of a sudden they begin to think very bad things, and so it's easy to communicate the negative effects of that without actually understanding what those actually mean and what firms are actually doing with those things. But in any event,
do you think that the same applies for this Funny Friday we had a few months ago, and for the oil increase we had just before the crisis? That also the hedge funds had nothing to do with this?
Well, I'm not saying that I don't think hedge funds have roles to play in market manipulation, because I think that they do. But in this particular crisis, which was,
And by the Funny Friday, you mean the flash crash?
Yeah. No, it's not. I just want to. I just wonder, are they potentially dangerous even if they didn't?
The Wall Street securities firms, even though everybody calls Goldman Sachs a hedge fund, and that's a nice little phrase to label them with. I mean, it's not the hedge funds, even as they exist inside these firms, that cause the problem. I mean, it's what you were talking about. It's human nature and the incentive systems, and Wall Street has got all these creative people. They're very, very good at financial innovation. So whether it's junk bonds or internet IPOs or mortgage-backed securities, they're all very, very good at creating these securities. And then because Wall Street is a sales force, it's a huge army of salespeople whose incentive is to sell, and damn the consequences. That's what they do, and they don't know when to stop, and so that's why we have these bubbles, because they keep selling these products as credit quality deteriorates related to them, and what was a very good idea, gets destroyed in the actual implementation and the selling. So to answer your question, is one thing I'm interested in watching, I have been watching with great fascination, is how these Wall Street firms deal with the fact that this ridiculous Volcker rule exists, and they have to get out of whatever they're calling or whatever they want people to think are their proprietary businesses, proprietary trading. So you have these Goldman, quote unquote, shutting down his proprietary trading business. You don't really know what it means because it's completely opaque. So they say they're shutting it down, they say they're unwinding their positions, and they, KKR then purchases these 9 traders or whatever, and okay, it's done, we're done, we've satisfied the Volcker rule. Oh, by the way, we still have huge private equity funds, we still have hedge funds. Oh, by the way, JP Morgan Chase, they can keep Highland, they're a big hedge fund operation, so there's all these caveats and carve-outs and inability to really, there's no clarity whatsoever around these things. But I think that places like Goldman, are trying to get ahead of the curve so they can at least say, oh, that we're out of that business, so we're complying now with the Volcker rule. I know they think it's ridiculous, but they know that it's the law of the land and they have to comply with it, so they're trying to get ahead of it. But who knows whether they've complied with it or not, or what it really means. So that's one thing that I've been watching.
Lawrence, do you see any possibility of dealing with the problem you've identified of enormous scale and huge
I think it's
interconnected impacts in the implementation process?
I think it's linked in a way to what Bo has just been saying, which is the Volcker rule is probably, you asked earlier, what is one of these processes, which is the one to watch? If we had to pick one, I think watching what they do with that is going to tell us a lot about what happens in the end to the disposition of the regulators towards the industry. For this reason, the Financial Stability Oversight Council asked for public comment on the Volcker rule, and a lot of people have submitted comments, and they break down into 2 camps. One which I think very accurately does say that hedge funds and private equity trading and private pools of capital did not cause the crash. And then the other side, which is people like Simon Johnson, who's often in the media, vigorously supporting the Volcker Rule and wanting as broad an interpretation as possible, because I think that where he is really coming from is this deep-seated concern about the scale and intermingling of traditional banking with investment banking. Now that problem started long ago, even before Graham H. Bliley, as a result of their decisions. But once we went down that road, and once we let Goldman and Morgan take out bank holding company charters, we really got deposited insurance funds, which translated to taxpayers, ultimately, backing the operations of these institutions. And I think there's a great fear that, yes, it is true that a hedge fund didn't trigger any of this, but long-term capital management once crashed, and if that had been a part of Citi, actually Citi's a good example. Vikram Pandit's fund was, what, $450 million. Citi had to write it all as part of, essentially a sign of bonus to bring him in. And Citi was big enough to absorb that, but I think there's the fear that you've got two very different cultures. You've got a traditional banking culture, which should, or used to be risk averse, and it was operated on a 363 rule. You probably heard the old joke that you charged, you paid depositors 3%, you charged borrowers 6%, and you were on the golf course by 3. Very stable business, but it was kind of boring. Traditional bankers tended to be people who didn't see themselves getting very wealthy. They thought they'd had a good job. A lot of them are young retirees from the military. Then you've got the high risk takers, which are the Wall Street investment types, also perfectly legitimate function in society, but with a totally different attitude toward taking of risk. Recognizing it's a risk-reward equation, and sometimes they'll lose their shirts, and other times they'll make an awful lot of money. And you put them together, and I think the danger is not so much that it didn't cause a crash this time, but what it is doing to change the culture of the universal bank. And I experienced that when I was working at Covia, and we basically built up a fairly substantial investment bank. It was not one of the top players, big broker-dealer, which was one of the top players by the end, and a traditional bank, and the different units didn't really understand each other at all. Now, it all came together at the operating committee and CEO level, but I know that the operating committee and CEO did not fully understand the range and depth of the business, because you were one mindset or the other, when in fact a company did dabble with high risk stuff. Of course, it ultimately ended up crashing and being destroyed. And I think that's the fear. And so the Volcker Rule is a bizarre thing that came out almost, Volcker looked almost surprised when the president actually announced it. And the conflicting interpretations of what he really means are really quite interesting. The American banker says Volcker wants a short, simple rule. And other reports of what he has said about his letter, which I was actually trying to find this morning, I wasn't able to find it, is he says don't make a rule, because the moment you have a rule, they will game it and they will work their way around it. So have a vague standard that nobody knows whether it will be applied or not. And so it's two completely opposing visions about the self-same person. But I think underlying it is this concern that we've gotten our financial system enmeshed into things that really are potentially very dangerous for the taxpayer side, as opposed to the high rollers who are willing to lose a lot of money if they have to.
Lawrence, do you think it's plausible that the definition of a systemically significant firm could lead to a process of divestiture, where you don't want to be on the list?
Think of all the obstacles that have to be overcome at first. First of all, the definition is a potpourri of criteria, some of which are laughably irrelevant to systemic risk, but some of which are, with all their vagueness, are relevant. If you threaten the stability of the financial system of the United States, then you can be brought into it. The Secretary of the Treasury, all the, and there are various procedures about how this happens, but all of them end up in court on an expedited review procedure. And it's hard to imagine that if the board of directors resist this, say you're a big finance company that's not covered as a bank, and you get designated, it's hard to believe that you would accept being dragged into this very much more ferocious realm of regulation without a fight. So we're going to have, there's the right of appeal all the way to the US Supreme Court, which is a very unusual right of appeal. And then the regulators after that, assuming this all works, and assuming it's done before a crisis, because I think in crisis circumstances you'll see that happen, but then it's way too late to make the system work. Assuming it all happens smoothly and that they bring one of these companies in, it's not a bank, the Fed then has to impose a whole panoply of discretionary restraints, and you mentioned one of them, breaking them up. If the criterion is if the institution's activities pose a grave threat to the economy, they can order dissolution and breakup. And we've seen a little bit of that where the government's money is put into the company. So, for example, a lot of pressure on Citi to shed some of its subsidiaries. British government has done that to Lloyds and to the Royal Bank of Scotland. But where that is not the case, I can't imagine that this won't end up in protracted judicial proceedings. I think what's happened is the institutions have become so big and powerful that I don't think they, for the very reasons that Dan mentions, can see the conflict that they are creating themselves. I know exactly what he's talking about because I remember being in the corporate world and believing all the Kool-Aid. It took me a year or so to detox on a much lower salary at Duke before I could actually see things a little more clearly. And I probably absorbed some other conflicts that I'm not aware of. But I don't think that the captains of these organizations see themselves doing anything but good for their shareholders and good for the economy and good for society. That doesn't mean they're right. I think they genuinely believe in the righteousness of their actions. And that always triggers litigation, because there's a sense of grievance. So I think it's a wonderful thing in theory, but I'd love to see one of these companies go through this process and go through it without a huge political row.
So we've been mostly talking about the goal of bringing about more stability in the financial system. But there are other goals that are percolating in this legislation, and one of them is consumer protection. Dan, any thoughts about where the implementation might go there?
So the spirit is sunshine policy, right? Let's just make everything apparent and let's see whether people behave differently. I've asked recently, so in the last couple of months, I've been asking people how many of them read the information about their portfolio. When you invest in something, they send you pages and pages of stuff you're supposed to read, and depending on where you have your money, they have you sign or at least click something. Nobody I've met have read it so far. And the other thing is a real issue. You can make these 10 times longer with lots of other information. And it's a two-sided question. So we can force the institution to divulge more information. We know the same thing as well. Like we give subject instructions, people have to sign a consent, informed consent, to participate in our experiments. We know very well they don't read anything. And if we wanted to put stuff in there that the IRB, would be happy with, and put lots of stuff that nobody ever reads, aside from the IRB, there will be no problem in doing that. So we practice this as well. It's not just the banks. But the banks will have to do it, and they'll probably do it. Then the question is, will consumer ever have a look at it? That's one option. The other option is that the banks will think that the consumers will have a look, and they'll do something. Or there might be created some clearing mechanisms that would do something that would help people very easily do something. If we take a lesson from the FDA, it's hard to imagine that anything like this would happen. So every drug has a huge report about safety and risk. People almost never read it. People make incredibly quick decisions. There's not a single mechanism that has been created to help people figure out what's dangerous and what's safe. So I think it's way too broad. That if you think about, I don't think it's ideal. If you think about the labels we put on food, they were supposed to be an incredibly simple way for people to get the essence. And of course, there's games around those as well. But I think we need to get to that level of simplicity for people to actually take the information into account. And I think we have to dictate exactly what the warning label on any investment would look like. No 10 pages and not all this information. This is the format and these are the parameters. And without that, nobody would use it.
And that sets up the battle, because if you take a credit card statement now for the first time, there's this little disclosure on how long it will take you to pay back if you do the advised
Yes.
minimum, 30 years to pay that back. All of a sudden, people will start doing that, but the bank will see, the card company will start losing revenue. Right?
Yeah.
So
That's right.
it's going to be resisted, because ambiguity and complexity is precisely how the revenue is generated.
Yeah.
One can imagine a similar set of,
Can I say,
Yeah.
here's, this is a very simplistic view on this thing, but so I think people, in regular banking, people love free checking. Right? They love free lots of stuff. Free checking is one of those things. I'm guessing all of us have free checking. And guess what? It's not really free. Some people are paying for it. And it's not your float that the bank is making. Who is paying for it? It's the poor suckers who bounce a check and pay $35. The people who use their ATM when they don't have enough money and pay $35 every time it happens. And it can happen 7 times a day. Those are the people who are subsidizing the rest of us. And that's a system we've created. Now, if you think about it, a bank is creating free checking, can't really go away from this. Right? It's very hard to tell the officer, hey, how about $10 a month? Wouldn't you want that? No, of course not. We really want free checking. But the desire to have a free checking created incentives for the bank to abuse the people who have very little money, to subsidize the people who are actually okay. So we have this incredibly crazy system. The same thing happens in lots of stuff, right? It happens in insurance and so on. But in banking, in particular, I forgot what it was last year, like $17 billion in overdraft protection, covering loans that were really short time, sometimes a few days, and that were much less money than that. Because you can buy a latte for $2.50 and you have to charge $35 overdraft fee plus the $2.50 for the coffee. Now, this is a situation where I think individual banks cannot get out of. If you're the first bank to say, you know what, no overdraft fees, or we'll charge $5 for an overdraft fee, but we'll charge everybody $10 a month for a checking account, this will not be a very popular bank, but all the people who have money. And this is kind of a coordination problem, right? Only the government can actually solve in telling all the banks, okay, you all have to do that. Everybody is playing on equal.
so you would be interested in seeing this new Consumer Financial Protection Bureau looking at questions of defaults and structured options.
Payment, and who is really paying for banking? Now, banks are...
So in other words, the norm is going to be that this is the policy that we expect you to offer, or if you're going to sell a mortgage, it should be a plain vanilla mortgage, at least as one of the options.
As a starting point, yeah. And the last thing I want to say is that I was kind of really depressed when I forgot who came with it. The Obama, slap on the wrist on banker's salary came out. It was, I think, in July. But they basically said, it didn't seem like it was a good deal, but a good idea, but we're not going to do anything about it. And that I think is a very depressing state, that there was no set of expectations or guidelines, not to mention regulation, about salary structure. And I think that's just crazy. And because of the salary structure, also the banks have huge incentive to become bigger. So if you think about how much can a CEO makes if he has 200 branches or 400 branches or more money under.
And there are a lot of studies that have shown that there is a direct escalation in salaries that is disproportionate to the scale of the bank. It's a much bigger league if you can double the size of your bank, not just double the salary.
Yeah.
So just one comment about this process of implementation. It occurs to me that in some respects, the goals of the legislation cut against each other. And so, if it is the case that more consumer protection means serious hits to bank profits, well, that has implications for systemic stability. So how the implementation balances those two things is going to, I think, be very interesting to watch out for. One last question before we open it up. How will we know say in 5 years, whether this legislation has been beneficial or not. Aside from there not being another blow up of the world financial system, which would be an obvious failure.
Now, I would throw out something that might be unexpected. We'll know when graduates, if you look at other careers as being attractive.
Aside from investment banking.
Just from banking in general. I mean, the financial world does not need all the rocket science. And we're actually draining other areas of the economy by diverting people to the totally understandable enticement of the big bucks to be made on Wall Street.
I think Larry's absolutely right about that. And that's where it'll show up first. And by the way, there's no sign that I've, not that I've done any detailed study, but empirically I was at Princeton earlier in the week, the Duke of the North, and this guy, very earnest, very smart, used a phrase I've never heard before, to I-bank, which is the verb configuration of working in an investment bank. So to I-bank seems to be all the rage still at Princeton. And it's completely, as Larry was saying, understandable because, incredibly, I just am mystified. I wrote a column in the Times 2 weeks ago where basically I said, I don't understand why bankers get paid what they get paid. It makes no sense to me. Some great economist can talk to me about, supply and demand and all that, but it just makes no sense at all. And this year they're talking about 150 billion now of compensation going to bankers in the form of bonuses. I mean, how incongruous is that? It's just extraordinary to me that we as a society allow that to happen. 2 years after bailing out this whole sector and to billions, quasi-trillions of dollars, and now these people have the cojones to take out $145 billion in bonuses on top of what they took out last year and the year before, and there's no repercussions in our society for this. I'm virtually astounded by this, and there's nothing in the legislation. There's no public outrage. There's nothing from our government leaders that are addressing this point. It blows me away. So that's, I agree with Lawrence then that therefore, when people at places like Duke and Princeton, choose other careers, is when we'll know that the heat around pushing paper around has gone down considerably, which is where it should. And once upon a time, nobody had any idea what Wall Street was. When I was here, and nobody knew what Wall Street was or cared about it. I mean, that wasn't so long ago. I know I'm old, but that wasn't all that long ago. And now people talk about it to I-bank. So something seriously has happened in the last generation that has, I think, resulted in not only one crisis after another, but the way we think about what's valuable in our society.
So for me, there would be two things. Consumer confidence is a big question, right? So it looks to me like confidence is eroded in a deep way, in a way that is not yet reflected fully in the market, because what are you going to do? The 401k money goes away, there's nothing to really do. But, so money does flow into Wall Street, and people do take bonuses, but I think the lack of confidence is incredibly deep. The question is, will this type of regulation restore any of that? And the second thing, which I hope will happen, is that there will be new banks that will emerge. So I thought of this crisis as actually an opportunity. Because if before the crisis I thought that whoever was my banker, if I had a banker, I wanted him to be the greediest, meanest banker around, because this would be the one that would get the highest returns. All of a sudden, the intensity and the size of the crisis made me think about bankers a little bit more like policemen and firemen. Like here they were having potentially a really important function of getting the economy rolling around. Now, they're not lending enough on behalf of these complaints, but in principle, it shows you the other side of banking in I think, a very positive way. That actually banking could have really positive effect on the economy. And I was hoping, and actually there were a lot of signs in the beginning of the recession that new banks will start emerging. There's all kinds of idealistic new people that wanted to open new banks with no fees and transparency, and more like ING than Bank of America. And actually the regulation made it much harder for them because of the demand on capital is so high. It's really hard to start a new bank today. But I am hopeful. If I believe anything about capitalism, is that competition does help. So if we would have other competing banks that were more, I think, idealistic and in the service of their consumers, transparent, with normal salaries and so on, I think they might have a chance to pull the banking industry with them a little bit. So that would be my kind of hope that they would emerge.
And is that vision about a relocalization of financial services? In other words, a smaller scale, more situated in communities?
So I was hoping so in the beginning. I hope that the federal credit unions would have a huge role to take, because they are local and they have more mission and they're structured in a different way. But actually, so I have lots of people come and talk to me, and there's all kinds of internet banks in this country and in South Africa and Australia that are trying to break them all. So I'm not sure it will be just local, but I think it will be good banks with good ideology. There was actually one that I don't think would work out, but they had a bank that the goal was that the assets of the banks are going to be invested in education. So the kids were going to own it, in a sense. And their ideas were, who will default on a loan when the money is actually going to education? Will that kind of mitigate them against some risk? I don't think they're going to go anywhere, but there were lots of nice ideas that I think have an interesting potential.
I'd like to open it up for comments or questions from the rest of the people. Yes?
It's a great discussion. Thank you. My name is Matt Mikowski, and just fascinating to be here. I have a question for the panelists, and that is their view on whether they think that enough attention has been placed as part of this regulation process on the underlying causes as a way of understanding where the next problem might take place, as opposed to putting the fire out, where it's been, and creating all this framework that's going to, make sure that fire never happens again. That's because the structure is burned down, and now we have to look somewhere else. And what I'm getting to is this great chart that was put together, and you see the size of these banking institutions. You look at the two of the largest, the UK and the US, the two greatest trade deficit countries in the world. And so it just, and then you look at the others, France, Japan, Germany too. Fundamental structural problems in terms of changing demographics. And these are nations that, Germany's obviously, the second largest exporter after China. But the real problem here is that as we're the debtor nations, that is, our deficits are being funded by the capital flows coming back from 4 countries that really hardly even show up on this, the BRICS, Brazil, Russia, India, and China. India, Russia, and Brazil are even on this list. China is here, a very small dot. And they're the engines in the world economy right now. And so you think about what's happening, sort of the underlying root cause. I'd say the problem is there's a ton of capital coming into the United States. It's got to be invested. And we don't have productive places to invest it. We don't have the businesses, the factories, so what do? You create some kind of synthetic security, and you create all sorts of ways to make money. That's why the rocket scientists are going into that area. That's the product that America has been building, and it's transitory. It's only going to last so long, because the United States isn't going to be able to maintain its position as a debtor with the kind of trade balance that we have. So I don't mean to preach on it, but I think it's a major problem. We're putting out this problem here. It's going to take care of itself based on the trade deficit. But my question is, the next problem is going to obviously go to those countries that are accumulating the assets. It's going to go to India, it's going to go to China. And what do you think is being done, in that context, to learn from what's happened here and prevent that from happening? Is there any positive benefit from our regulation discussions that sort of creates a way to push off or prevent the next crisis from taking place there, which will be truly huge?
you've got your timing couldn't be better, because right now the soul of the G20 is exactly what this is about. And I don't think that we appreciate just how fundamental the problem really is. I think you described it exactly right. The imbalances and the need to keep generating a synthetic industry because we got rid of the real economy.
But India, for example, had a much stronger regulation all along. The reason they have not been affected is because of that. I think for India, for example, this was a good wake-up call. They had a lot of pressure to relax regulation, and I think it was good timing from their perspective that the crisis happened, and they're not relaxing the regulation. So, I'm not sure about China and other markets, but I think I'm not sure so much our regulation is going to have an effect, but I think the crisis is creating tremendous fear and a warning sign. Maybe and the same thing happens with in Brazil. Brazil actually has tremendous regulation of the markets, and fiduciary responsibility are much larger. There's no you can't get what's the insurance that people get on boards if you're the CEO and
Do you know?
yeah, there's no I mean you can get you're personally liable
Yeah.
for doing bad things, and people are being sued and they're worried, and it's a very different world. So I'm not sure that they're going to have to face the same catastrophe that we have.
You know, with the savings and loan crisis, 20 years ago, 22 years ago, 28 executives went to federal prison. Now I'm really struggling to think of any who did, except for those who stole from the TARP fund, the guy in New York. But I mean, nobody's going to prison anymore.
So the companion to the concern that you raised, Bill, is this one. Where's the rule of law in the United States now? In light of all that has transpired and that continues to transpire, say, with the foreclosure crisis.
Well, somebody should do a study of all the criminal convictions that J.P. Morgan and a number of the other big players have accumulated in the last year as a company, not as individuals. And I think we'd be shocked that if somebody was a repeat offender like that, and they were an individual, they would certainly have gone past the 3 strikes and you're out long ago. I mean, with municipal bond fraud, and it's global too. I mean, I've often wondered about getting a researcher to do this study and just pull it all together and say, this is what this company looks like after a 10-year track record.
Yeah.
But we don't do that. You know, they're very powerful.
I mean, I think probably more than a year ago now, I had a column in the Times about how there's been no one held accountable for this crisis, where I think there truly were criminal acts. And I think it's obviously still true today. I mean, you had, it's just, one example, the only 2 people who were indicted criminally, and I'm not talking about Madoff and the guys who were running, Ponzi schemes. I'm talking about people who worked at Wall Street securities firms. The only 2 that were indicted were these 2 Bear Stearns hedge fund managers. Now, not intentionally, but just telling the story of what happened there in my book, I virtually ended up, I think, laying out a prosecutorial roadmap for the U.S. attorneys in New York, in the Eastern District of New York. There was some, competitive stuff going on between the Southern District, which usually brings these cases, and the Eastern District is in Brooklyn, which brought this case and ended up with egg on its face. I mean, there were so many infractions that these hedge fund managers did, completely misleading and deceiving their investors. I found a memo that I wrote about in the book that was used by the Bear Stearns management as a talking points memo to try to explain, after the funds had blown up, to investors something about what they had been investing in. And it lays out, this is, even though investors were told that they were only investing 6% in subprime mortgages, these 2 hedge funds, actually, sorry guys, they actually had invested 60% in subprime mortgages. I mean, you couldn't find, more smoke coming from a gun than something like this. And that was just one example. I mean, I laid it all out, and there were plenty of memos, plenty of emails. It was, and they completely blew it. And why? I mean, they relied. If you look at their indictment, they decided to cull from snippets of emails that these guys had sent to each other in their sort of weakest moments in the spring of 2007 when they were questioning everything they were doing, and use little snippets that made them look devious and criminal. But of course, I had seen the whole email, which has all sort of equivocation going on about how, well, on the one hand this, and on the other hand that, and I woke up on the wrong side of the bed today, so let's sell everything in the hedge fund. Well, no, man, I was acting too rash and things like that. So any jury is going to see these memos, the emails in full, and the court's going to say, I can't decide beyond a reasonable doubt, and so they get acquitted. And what's more incredible is people come out of the jury room as saying things like, "Oh, I would have the jurors. I wish I could have invested my money with these guys." And they had just lost $1.5 billion for their investors. The jury had just acquitted them, and they come out and say, I wish we could have invested with these guys. So the power, the combination of foolishness on the part of prosecutors and the out-and-out power that these firms have in Washington with Justice Department, it's really another distressing aspect of all this. So there's been apparently, how long does it take? A federal grand jury, apparently 3 federal grand juries have been investigating what happened at Lehman Brothers for the last 2 years. Now, how long does it take? There was a report, this examiner's report, 2,000-page examiner's report done by this lawyer in Chicago. They paid $60 million, the bankruptcy estate paid $60 million for this report. It's an amazing report, and it details all the things that he discovered that Lehman Brothers executives did wrong. What more do you need? And yet there's not an indictment, there's nothing.
Yeah, Tim.
Thanks, Tim Butte. I was wondering that at least 2 of the 3 of you, if not all 3, seem to agree that part of the problem is that you're attracting the wrong kinds of people into banking in general or investment banking in particular. And so that would seem to suggest, and most of that is about financial incentives. So that would suggest the kind of salary caps that have gotten a lot more coverage in Europe would seem to be a promising way to go. And I was wondering about your assessment on that, particularly given that it seems to me that the Volcker rule was intended to deal with at least some part of exactly the conflict of interest that at least and 2 of you emphasized, and yet you all 3 seem to be very skeptical about its effectiveness.
Well, I'm going to just hop in here first. As somebody who spent 17 years on Wall Street, and maybe we can't recognize, people can't recognize their own internal conflicts, as you were saying. It's not that the wrong kind of people are, I think that earnest, hardworking young people want to go to Wall Street because it is an incredibly interesting, it was never boring for 17 years. The problem is, in my judgment, in addition to the whole compensation scheme, which, frankly is amorphous at the individual level. You hope that you do a good job and then you get paid well at the end of the year. The problem is that very quickly, as you spend time in it, a couple of things happen. One, you get incredibly seduced by the compensation. In other words, the total amount of it. I was a reporter before I went to Wall Street. I could have worked my entire career as a reporter in Raleigh and made less in 1 year than I did on Wall Street. Okay? Now, why is that? That's what I said before. I don't know. But the other debilitating factor is that when you see the kinds of people and the kinds of behavior that people get rewarded for on Wall Street, all of a sudden your vision of what the role model should be gets totally turned around. So you think that, well, I'll just put my head down, work hard, do a good job, and I'll get rewarded for that. That's American is apple pie, right? Well, it turns out you go to Wall Street and you see the kinds of people who get rewarded. They get rewarded for, sticking a knife in their colleague's back, sucking up mercilessly to, the guys who make the compensation and the promotion decisions. So, they don't return, they're not team players, they don't return their colleagues' phone calls. I mean, I could go on and on. I've written 2 books about this, and what's the third?
It's another version of the social norms of the used car lot.
I don't know specifically, but I think you're absolutely right. I mean, bad behavior gets reinforced. So you have these people who go in, very earnest, very hardworking, very idealistic, and then very quickly they see, well, if I'm going to succeed in this little environment that I got here, I'm going to have to turn into somebody I don't like. And that really, I found extremely debilitating. But then you say, how do I get out of this? I mean, banking has become a very high beta profession. You get paid too much, and since between 50 and 60% of every dollar of revenue goes to compensation. I mean, what other profession on the face of the earth does 50 to 60% of every dollar of revenue go to compensation? The answer is none. So, maybe law firms or consulting firms, but they're much smaller scale and they're partnerships, but in terms of public companies. So the question is, you get seduced into it because of the big money and the way these smart, good-looking people tell you, how great your life can be. And then once you're in it, you're just like a heroin addiction. You cannot detox from it. You can't get, I found when I got out of banking in 2004, I was being paid all this money. I was an M&A banker. I was at the top of my profession. I had no skill whatsoever that was transferable into the real world. And we've created a generation of people who are exactly like that. I was fortunate I could write, so I started writing about it. But I can tell you there's a bunch of people who look exactly like I do, who are in the late 40s, early 50s, who are probably sitting at home now, coaching their kids' soccer teams because they worked on Wall Street and there's no outlet for their services anymore.
So I absolutely agree with this. So just to reiterate, I don't think it's the wrong kind of people. I think it's just people. I think that you too would be able to see financial products differently if you got paid $5 million a year for seeing that. Right? So it's not those people. That's the exact problem with conflict of interest. You can see those people, but you would be exactly like them. And the second thing is this evolving social norm is again something we don't appreciate very well. You think that you are who you are, but 50 years of social psychology show that you're much more prolific in your environment than you think you are. And when you see people behave differently, it's not often that you say, oh, I have to turn evil, but you slowly change what you think is the right way to behave and what you find is the ideal and who you want to follow. And it's very hard to appreciate from the outside how those two forces of social conformity and conflicts of interest shape people's behavior. That's why I think you're absolutely right. How do we, and every time we have fee for service, percentage, payment, we have conflicts of interest. The only way, here's the thing. How many of you would want to go to a judge that you know got paid by a percentage of the verdict? Right? Hard to imagine anybody would put themselves into this situation. That's exactly what we do with bankers. Right? Exactly what we do with our physicians. Right? There's lots of things that we just did, and it's kind of hard to understand why we're understanding it so well in justice, and we're not willing to take the same lesson in banking.
Hi, Christine Bader. I'm also on the Cohen Advisory Board, and I work for a UN initiative on business and human rights. So, criminal acts aside, banks make so much money in part because clients are willing to pay them big fees to do what they do. And so,
Actually, can I stop you there for a second?
Sure.
So, how much do you think clients would be willing to pay if it was not framed as percentages by a fixed fee? So imagine you're a banker, and imagine right now they charge you 2 and 20, like a hedge fund, versus imagine they charge you a fixed fee every year. And it wasn't a percentage, but it was an amount. Do you think you'll be willing to pay the same amount? Hard to imagine.
Well, I mean, I think there are lots of different clients. If you're talking about retail banking, or if you're talking about
Somebody manage your personal fortune. Yes.
well, so I guess you're already anticipating my full question and giving an answer, but let me ask it anyway. So if the problem is that banks make too much money and bankers make too much money, and you're trying to legislate against that, where is that money that they're willing to pay supposed to go? Are they, are you trying to legislate they should really pay the banks less, and they should be returning the money to their shareholders? Or maybe the argument is that the clients are held hostage by the banks that are charging these fees. I don't know. So it's just a question of sort of yes, bankers make too much money, and as a society, there's this distorted value that we place on their services. But given that that's the case, sort of where is that money supposed to go?
Well,
If that's what the market is bearing.
Here's the way I think about it. First of all, you're absolutely right that if clients didn't pay these fees, they wouldn't have the revenue to pay out 50 to 60% of every year. Problem is that, and I said this to a former CEO of Goldman Sachs the other day, and I thought he was going to have a heart attack. Wall Street is a cartel. So I mean, OPEC, it's no different than OPEC. And now it's even more of a cartel than it was before this crisis. So you've got, they set prices for their services, and basically they don't move off of them. Whether it's M&A services or financing services or asset management services, you can go down the whole list. They set the prices. Now, it's ironic that they could also act, so they act like a cartel when it comes to pricing their services, just like OPEC. But then they cry, oh, we're at the mercy of the market when it comes to setting compensation. And if we got to pay Dan, $15 million a year to trade convertible with preferred securities, or else he'll go over to Deutsche Bank and get $16 million, so I got to pay him. And so I was wondering, why don't they act as a cartel when it comes to the compensation issue as well? Considering that, as I said, 50 to 60% of every dollar of revenue is paid out in the form of compensation. Think how much more profitable these firms would be. And it just goes to the insanity of how they're able to fix their fees and not have a market-based fee structure. And then they're able to pay out 50 to 60% of every dollar of revenue in the form of compensation. Think how much more profit. So that raises me to ask, who do these firms really exist for? Do they exist for the benefit of their shareholders and their creditors? I don't think so. They exist for the benefit of the people who work there.
But the implication of this point is that there's a very close nexus between Lawrence's first point about the structure of the industry and your first point about compensation practices. Because the cartel that you're describing is animating the
That's
both.
exactly right.
So the main logic in economics for competition is that competition basically drives prices down, and they should go to production costs. Right? Eventually, all margins of profit should be very close to zero. And it's kind of interesting to think that people on the Wall Street are the most capitalistic, competition-believing people in an industry that is a perfect commodity. Right? I mean, what's more perfect commodity than banking? Nothing. How are the prices not? How is profit of margin not getting to zero?
Well,
I mean, it's really kind of an amazing.
This is the insidious thing. It is in this respect. Once you get below that executive tier, not only have salaries not risen for some time, but they've essentially dropped to the extent that there's been offshoring and use of labor arbitrage. So even for the employees of the financial services industry, it's only the executive layer and the...
But that's a thick layer. It's a very. I don't know what you call it. Executive.
From an investment. Well, it's not. It's actually not a very thick layer.
I forgot how many people make more than $1 million a year, let's say.
In a traditional bank or in a bank or And
There are no
everything that comes
traditional
from-
banks.
Yeah, but if you were to take, say, Bank of America, and say, leave aside its capital markets group, leave aside its broker dealership, the bank itself, a large majority, very large majority, probably 70% of the employees would be earning what is not a shocking level of salary. And then the 30% would be where the extraction comes.
Yeah.
In the form of bonuses.
No, sure, but you know, there's a lot of them. You don't make 1.5.
What we really want is we want our banks, I think we've all concluded in my humble opinion, we want our banks to be more like utilities.
Well,
Provide a simple service, provide the services that that they're good at. Advice on M&A deals, advice on investment, and raising capital for companies that need it. That's what they're good at, that's what they used to do, that's what they were boring utilities. People have told me, well, the whole Wall Street changed when the MBAs got involved. You know what? I think that's right. I mean, if you look at Sidney Weinberg at Goldman Sachs, he did not graduate, he did not go to high school, he barely graduated from elementary school. He showed up at the tallest building in downtown Manhattan one day, and went from the top floor to the bottom floor until he got to the third floor, which is where Goldman Sachs is, and they hired him to shine the spittoons. Okay? And from there, he built a huge and powerful investment banking firm. But there was no MBAs. The MBAs came along, and talked. And next thing you know, you've got synthetic CDOs, which.
I know MBAs, they can't come up with that stuff.
Well, they can come up with marketing it and think about it and be clever.
Okay, if I make one more comment, so this percentage thing, it's really interesting what people find is fair in pricing. So I had dinner with the guy who runs a hedge fund called Blue Mountain Capital, and I said to him, and I think his 15 biggest clients, and I said, can I ask the client some questions? He said, go ahead. And I asked them questions like, what would happen if they weren't charging 2 and 20? What if it was 1 and 30? Why is everybody charging the same thing, right? Why aren't there differences? What if you got a 5% discount? Would you put more money? How much more? And they basically said, we don't care. We're used to being charged 2 and 20. That's the amount that we pass to our client. You charge us more, you charge us less, we would suspect you. Like everything we know about capitalism and desire to get better prices and negotiate, that doesn't seem to work in this world. It's a really strange thing. You would hope that they would fight with them and negotiate.
It's actually also evident in another area that's not often well watched, which is in the mergers and acquisitions, where you remember Mercedes used to have a marketing approach, which was, if you have to ask the price, you can't afford it. This is now if the team comes from Goldman and they are talking to the CEO and CFO, the very last thing those two people who are about to experience a dramatic increase in their status is going to quibble about the fees. In fact, it's, these are big fees, we're into the big league. So it's like egos come in and start distorting judgment as well.
Yeah. And so I think that, the reason that lots of people are paying 1% of their portfolio every year to a financial advisor who knows very little and can optimize their portfolio, it's just not worth the money. The reason that this happens is because it's a percent. And people think it's somehow okay. Okay, I make money, 1%. I think if we change the rules and you had to have a fixed fee, people would be much more fee averse. The amount that you'd be willing to pay on the percentage versus a fixed fee is going to be very different. And that, I think, is an implementation issue. Right? The moment you would implement something like this, you would say all fee needs to be expressed in dollars rather than percentage. I think things would change.
Wayne.
Wayne Norman, I'm faculty at Cohen here in philosophy. I just want to rewind the conversation about 5 minutes back to the framing as Wall Street as with sort of the market failure of a cartel really at the heart of things. And Dan's question, and just sort of re-ask what Dan had been asking, which was or another way of asking it perhaps, which is what are the barriers of entry? So why is it that you couldn't get a more efficient, nimble much lower, the way it would be in any other industry that finds a way of producing something at a much lower cost. So what is it that prevents that kind of a player from, sort of succeeding in this industry where it would in car manufacturing or computer manufacturing?
Well, I think it gets back to why there's an oil cartel, because they've got the oil, right? I mean, they happen to have a piece of turf under which the oil exists, and they own it. And same thing with these Wall Street firms. Again, as I was talking about, once upon a time, they were small, they were undercapitalized, nobody knew who they were. Nobody knew who Goldman Sachs was, or any of these firms. They had no intersection with them, and that was just fine. And then, basically, over the last, 40 years, as they started going public, they started working on their brands. And Goldman, of course, was better at this than anyone else. They made it a point to talk about when you weren't coming to this bank for an individual. There's no individual person you wanted here. They're all interchangeable. We all have the 18 here. No matter who you get will be the 18, and it's not a star system. It's just Goldman, and so you get Goldman, and no one ever got fired for hiring Goldman Sachs. And so they worked on their brands. That was number one. So they made it seem like what was really a commodity actually had some value that you would actually come for and pay for. That's number one. And number two, even more important, was the capital. It went from being a very relatively low capital intensive business. Providing M&A advice requires zero capital. If you do it correctly, underwriting debt and equity securities costs very little capital. But over time, these became far more capital-intensive businesses, and I'll give you one example. So Gus Levy at Goldman Sachs came up, is generally credited with being the one responsible for creating the block trading business on Wall Street. What did that mean? So once upon a time, if Dan had $1 billion worth of securities that he wanted to sell, he had Coke or Ford securities that he wanted to sell in the market, he'd have to dribble them out into the market, and maybe Goldman would act as his broker for that service. And the act of dribbling out these securities would, in pure supply and demand terms, would create more supply than demand, and the price would generally fall. And so he would get, he would be kind of unhappy. I mean, Coke's trading at $50 a share. By the time I get dribbling out my $500 million worth, it's going to be like $40 a share, 30. I want that 50. I don't want to lose 10 points, on a share. So what Gus Levy came up with is the idea, okay, Dan, I'll just buy your whole portfolio for you. We'll negotiate some discount to the $1 billion face value. We'll call it $995 million. That $5 million is A, my fee, and B, it's now my risk. And I can dribble these securities out whenever I want, or I can sell them to somebody else. Or maybe I'll make a profit on them if I buy them right. But all of a sudden, you went from needing no capital to needing, I can't do the math, but $995 million of capital. And you multiply that across the whole spectrum, and that's just one example. And then you get proprietary trading, you get, warehousing of mortgage-backed securities, all of these things. And John Whitehead at Goldman Sachs used to say he didn't want to go public because with a limited amount of capital, we had to make choices about how we used our capital. And if we go public, we'll have unlimited amount of capital, and then there'll be no choices, and it'll just be a capital free-for-all. And that's basically what happened. And so, it became a capital game. The firms that are in the cartel have the most capital, just like the firms that have the most oil are in oil. And that's what we have.
And they also have the social networks, contacts,
And information networks,
and the economies of scope that all of those things.
absolutely. Which capital and wealth allows you to do.
Yes.
Lawrence, early on you mentioned that you weren't for the reinstitution of Glass-Steagall in any fashion, but then you gave the example of you're at the operating committee of an organization that has investment banking and commercial banking, and if you're at that level, where do you think those executives are going to allocate resources, given that you have the next line, CDO, which is going to pay the organization $18 million versus the more traditional Saudi banks?
And that dynamic is inevitable. The reason I said I would want to see Glass-Steagall itself reintroduced is because given the information technology explosion and the capacity for innovation, that simple wall doesn't work very well anymore. And that's the reason it was easy in the end for Congress to repeal it, although the city travel is going to really precipitate that. So I think clear, bright lines about products don't work very well. Innovation is going to lead to ways to get around it. And I think that's part of Volker's point, which is the sharper you draw the line, the more you're going to see abuse, because prohibitions actually can spur innovation rather than squelch them. But I do think that we have to think about ways to break down the dimensions of risk management and then force companies to prove that they've adequately covered the range, which I don't think they do now. They say they do, and they've hired armies of risk managers, all of whom got everything wrong 3 years ago. And the reason is that they're so reliant on abstraction as they get bigger that by the time you get a risk management, you have a dashboard, that was the popular term of IT, and you get a report that gives you like a heat map. If it's green, then everything's under control here. If it's orange, you need to be paying attention. If it's red, we've got a problem. But by the time you get it at that management level, it's already gone through so many different layers of individuals who are judging it more and more abstractly that it's essentially meaningless. It's not going to ever tell you where the problem arises. And I know we won't have a system that always does. You know, my old first boss at Wachovia said, you'll never see the lightning that strikes you. So there are going to be catastrophes. But what I think you can do is modularize the system so that when something does go wrong, you can contain the contagion that would otherwise happen. And so, you know, instead of Glass-Steagall, I would want to carve out the public utility of the deposit insurance funded business, which basically performs basic payment services, and try to separate out the high-risk activities and have, you know, the big rollers go and do that, but make sure that it isn't something that can come back and draw on the federal guarantee of deposit-insured funds.
Now, if you look at what the regulation is of money laundering, is so unclear what it is. Like the government doesn't tell you what money laundering is. We just said if we ever find that you've done it at any point in time, we can go back and sue you. We can go back years and years back and sue you. And you know, it's hard to know how it's working, but it looks like banks are really frightened.
Absolutely.
Because it's so ill-defined and so general. And I kind of wonder about this tension between, you know, exactly what you're saying, how specifically do we define it versus how general?
I think there's something to be said for what feels like a violation of the rule of law, but which is a prosecutorial discretion in areas where there are grey lines. The other thing, the outside, often one reads Sarbanes-Oxley, which was passed after Enron, was designed to promote financial accountability in companies. I vividly remember when that happened. It was the first time we individually started paying attention to the accountant. Before that, it was always if your divisional CEO said, the CFO said it was all okay, it's good enough for me, I'd sign. And then the one day at our meeting, my boss said, you do now realize that from now on, you can go to jail if you get this wrong. And it changed everything. But Sarbanes-Oxley, they were actually about to repeal before the crisis. So, you know, it's hard to convince the market that there should be that kind of heavy-handed accountability.
Is that me?
I thought you had
Yeah. Well, this has been fascinating. My name is Sarah Monroe. I teach law at UNC, and this has been fascinating panel to listen to because I actually teach financial regulation and law. I spent just only 5 years being a lawyer on Wall Street, so I kind of recognize a lot of these things that you guys are talking about. But I'm just curious about Daniel comment that you made at some point, that nothing we thought we understood about capitalism seems to be working here. Right? And that, to me, that captured the essence of our problem here. We can fix all those little things, how the fees are charged, and how much disclosure banks have to give to retail investors or whatever. And we will never get to the big crux of the problem. Something in the system, in the entire system, is off, right? We have this moral outrage. How come these private bankers are making all that money, and how come the government's not doing anything? But the reality is, we live in a society. This is America, right? The American capitalism is based on this notion that it is not the responsibility of any private business, any private enterprise to care about the society. It is not part of what they're for. The duty is to the shareholders, to the owners, right? So whatever you fight it out, you managers with the shareholders who gets what. But it's not about society. And it kind of brings to mind, I was raised in the former Soviet Union, and I was actually educated as a Marxist, right? And I was so anti-Marxist when I was there. And it's kind of ironic how that now, after having worked on Wall Street, now I'm becoming more and more Marxist. And I'm thinking here that,
This is a crisis of like.
this is my personal crisis of identity. But Karl Marx said in his philosophy, right, that the main problem with capitalism, or with any kind of social structure, would be that the means of production become more and more socialized, social. But the relationships that sort of organize how we use those means of production remain highly privatized. And I think we are actually coming to that point where that prediction might be becoming true in many ways, not just in the finance. We are now at a point where what one bank does involves so many people, so many social processes, affects so many people's social processes. But why that bank is doing that, and whom it benefits or whom it hurts, remains purely a decision of a fairly small number of people acting in their own private interest. So here's my question to you, the three gurus. So if you had to write a new, Dodd-Frank Act, put new names on it, for example, what would be one big thing you would think you put in there as the organizing principle that would actually go to some of that issue? How do we infuse the social public interest in why we even having a financial system, why we care about it, how would you go about it?
Well, I can answer that easily from my perspective because I had a piece in the Times about just this thing. And it goes back to what we were talking about at the beginning, which is, I think, human, and what Dan was saying so articulately, I think human nature is private partnerships where it was in everybody's interest to make sure that the society, the firm, acted properly. Because if it didn't, it was going to come out their entire net worth was on the line. Everything they had built up, all the wealth they had created could be lost in a nanosecond. Now, we began to change that over the last 40 years, and now we have this asynchronous risk model, this bonus culture. So what I propose, and what I would throw out the whole Dodd-Frank Act, the whole thing. If you just come back to one simple organizing principle, which is, since you can't put the genie back in the bottle and make these public companies into private partnerships again, I mean, you can do the whole LBO going private thing, but you're not going to take Goldman Sachs private. It's got a $100 billion market cap, so you can't do that. But what you could do is take the top 100 guys at these firms, the ones who make the decisions about how to allocate capital, what business lines to be in, who to promote, who to fire, who to reward, who to single out for great behavior, who to, get rid of, those guys. And I just picked arbitrarily 100 people. That they now create some sort of new shareholders agreement, and some smart lawyer can figure this out, where once again their entire net worths are on the line. There's some security that's created that is equivalent to all of the net worths of all these top 100 people. At Lehman, it would have been a couple $1 billion security. Stick that underneath the right side of the balance sheet, underneath the equity, underneath the shareholders. So the first thing that gets lost is everything that these people have worked for. That's the first thing that gets lost next time you have a little mini hiccup in the financial system.
Presumably with a serious lockup.
You could litigate, you could go to prison
But I mean,
Oh, a serious loss, there's no way out of it.
you can't,
You can be
there's
held
no
accountable.
market, there's also no market for those shares that you can.
That's exactly right, that's correct.
Call that from the
And
children.
can call back, and you can lose everything, and make them seriously accountable. One of the problems that I found in this crisis, and when I wrote about it, is that the executives were completely out to lunch. You know, so Jimmy Kane, the CEO of Bear Stearns, you know, he goes around saying, well, I lost $1 billion of net worth in all this. Yeah, I said, Jimmy, how about the fact that you squirreled away $400 million, you know, before this whole problem came along? And he said, yeah, you're right. I do have $400 million. I lost $1 billion. Yeah, I don't even care about that. And the $400 million, I'm not sure I even care about that because that just affects my heirs. I have everything I want. But if he had lost $1.4 billion, if he had $1.4 billion on the line instead of $1 billion, he wouldn't be playing golf, he wouldn't be playing bridge, and he wouldn't be smoking pot. Okay? And have no idea what's going on.
Maybe you will smoke more pot.
But so that is my solution. I can tell you that a lot of people thought that was an interesting idea. I got one call from Lloyd Blankfein, and we debated it for an hour. No, not one other single person on Wall Street talked to me about it.
Mr. Cohen, my friend asked Jamie Dimon at the J.P. Morgan info session what he thought about it, and he I guess raised the point you addressed, which is that he did have most of his wealth tied up, but as you say, he didn't have all of it.
Most is fine, that's nice. You need to have all.
That's a very important point. People, you know, once you understand compensation structures, it's only a piece of it. And a good example is the three of the executives from Wachovia who, remember, drove the company to the ground. Very people who literally destroyed the company. Each got massive cash payouts as a result of changing control. So, and, you know, it's a massive cash payouts. We're talking $19, $20 million each just for that event. And it was cash, not stock. Yeah, the stock took it.
Ironically, the guy who put his money on the line, Bob Steele, one of our favorites around this place, he lost $16 million.
Yeah, he was a hero in the whole thing. He's the only guy who actually really paid the price.
Yeah. Of course, he had all of his wealth that he had taken out in Goldman, so he wasn't, you know.
Yeah, I should have said I didn't mean to include Bob Steele. I actually think he saved us from the worst of what could have happened.
Well, these issues are not going away anytime soon, and I want to thank the panelists for such a provocative set of responses.
Produced by Duke University. Online at duke.edu.